All right, good morning and welcome to the Minervini Private Access Trading Room. I'm Bob Weissman. If we could do a quick sound check by raising your hand, letting me know you're hearing me okay. Hope everybody had a good weekend. And no need to talk to me about my Eagles. They lost. And let's also welcome Mark Ritchie into the room. Good morning, Mark.
Morning, everybody.
And if you could do a quick hand raise for letting me see that you're hearing Mark okay. And that looks great. And finally, Mark Minervini. Good morning, Mark.
Good morning. How are you?
Looking good.
Yep. Okay. Just taking a look here at some of these questions. I'm actually looking at the chat box right now.
Any market comment, Mark, or?
No, just this is, sort of what I've been expecting. And, this is the shorts working, and we've whittled down the longs, of course, where there's very, very few longs. So you had plenty of heads up here. I mean, there's no way you should be caught in this morning. If you are, you've been arguing with the market and with our analysis and with the risk model and with the STEM model. With Mark Ritchie and myself, what we've been doing. So again, we talked about just the other day, I talked about how, these stocks that have recently broken out, something like a Copart, down again today, of course, with the market. But, here you go. 1, 2, boom. You just see this over and over and over, so that 1 to 3 day window is still that short-term window, whether you're selling on that first day or you're trying to play it for a couple of days. Seems like that 1 to 3 day is really the the sweet spot window for short-term trading, and I think that's been the opportunity and continues to be. Well, now I'm not doing anything, but that's where we are. We just gotta wait it out. Now we'll see what if this turns into a deeper correction, or if we we get a quick little undercut of the 50 here, and then and we bottom. So it's yet to be seen. I think is a good, at least a 50-50 chance here. That's kind of, I know it can go one way or the other, but I hate when people say that. But I think there's, a chance that we could have a slide here, So, but again, there's no stocks really setting up, and that's what's really important.
Yeah. All right. So
And Bob, one last thing, I know it's, what goes on people's minds when you get into something like this, you start correcting. It's like, how much is this going to go? When is this going to be over? When will stock set up? Like all that forecasting, those forecasting thoughts and things like that. It doesn't, who cares where the S&P goes, the Dow? I could care less, and I'm not trying to guess. All I'm looking at is, are there stocks setting up? That's all I need to know. When there's stocks setting up, I'll buy stocks. When they're not setting up, I'll be in cash. I don't try to guess how long this is going to go, how far it's going to go. You should be very defensive right now and position for a correction here. And when stocks set up, you should be getting into stocks and positioning yourself for a rally. So that's, concern yourself with the stock setups. Don't concern yourself with this noise.
All right. Well, with that said, James is asking, what boundaries or parameters do you work with when you're short-term with your short-term trading?
That's a very vague question, and I'm not sure what that even means. So boundaries, I don't know what that means. So, again, I'm going to repeat this again for I don't know how many times, but I'm not doing anything different for short-term trading. I'm buying at the exact same spot. The only difference is Copart's a perfect example. Buying the stock on the, if you're buying the stock on the breakout here, the only difference is I'm just selling into the strength. That's it. There's no magic, no special formula, no magic indicators, no different setup. Buying the exact same setups. If there were no setups setting up swing trade type setups, I wouldn't be short-term trading. I'd be sitting in cash. As long as there's setups, I'm trading them, with the idea, of course, that I could be trading a swing trade. But if they're not working, I'm not going to sit in there and keep getting my head caved in on this, this 2-3 days up and then whammo, and I'm going to fall for this trick, every time. After a while, I realize this is the theme. So I'm going to play the theme until it changes. So the boundaries are, again, you've got to do that math. You may be someone who wants to, move real quick and don't want to hold overnight. So you're selling on that first day up. Now your loss is going to have to be super tight because, you're probably going to, have a very, very small average gain. If you're playing for a couple of days, your average gain might be a little bit bigger. So you can take a little more heat on the downside. If you're playing for a swing move, it's going to be probably a little bit bigger, but right now your batting average is probably pretty low. So you've got to make that determination, for yourself. It's really, really comes down to that average gain. That average gain, really is the key of where you're getting. It's like an insurance company. They try to figure out where, sorry, where the average person is going to expire, pass away. So when they take, they don't know where any one person's going to die, but when they take, thousands, tens of thousands of people, and they put them over a distribution curve, it's going to come on average to a very, very specific number that they can count on with incredible accuracy. Let's just say it's 77 years old. So now they know how to set their premiums, which think of it as the figuring out where the person expires as to figuring out where your average gain is going to land. And then from there, setting your premium would be setting your stop loss. Now you know where to set that, so you guarantee yourself a profit from the difference. It's no different than that, than actuary tables.
Chris is asking, on days like today, do you use any type of special intraday screening on Marcus Smith to find names that are holding up especially well in a day like today?
I saw this question, and I like this question. So I don't normally, it's not like I just run a screen, but I'll tell you what I do. Show you right here. As a matter of fact, I did a tiny little trade here. I didn't put it on this morning, but I bought a very small amount on FULC. I bought some on the pullback this morning, and I don't rarely do this, but this is a good question for right now because I'm going to show you what you can do. So let's just say you get a stock. I'll tell you sort of how I back into this. So if I know that you're going to have a big down day, all right, I'll look and see what happened, what stocks broke out the previous day, day one of breakout, and it was a big breakout. So really strong, big breakout, maybe from a power play, but you got good net progress. It's a real strong breakout. It had a good close. And now that next day, if it pulls back to the breakout point, I might buy that right on the open as it starts turning back up if the market's going to gap down huge, because it's like a weight holding the spring back. This is a stock that was up big and wanted to go, and most likely the market's pulling it back, especially a stock like this where you've got a stock that the market doesn't really affect this very much. I mean, this went up 300% in a few weeks. So obviously the market's not affecting this, but on a very short-term basis, it will on the open, just like today. And now it's rallied back a bit here. But again, this is so rare that I would even do something like this. Usually I would do it if I missed it. Like, I missed the stock, it broke out. I'm like, oh man, I wish I bought that. And now it pulls back to the breakout on a day where the market's coming in really hard. And now, I might go in there and just buy it, and I'll be right back where I would have bought it anyway. And then I'm going to want it to hold and bounce pretty quickly. Like I'm most likely going to, set my stop real tight, maybe at the previous day's low, or I'll come up with a percentage stop. So I'll be really quick to get out if it doesn't hold up right away. I want to see that previous day's strength carry over, right after the market affects it in the morning. I want to see it come right back.
Arnie's asking, what do you do when you are in cash and not doing too much trading? What should new traders be doing right now while they're in predominantly cash?
Well, David Ryan would say, read the Bible. Right, Mark? And that's not a joke. That's what he would say.
That's exactly right. That's exactly right.
So, again, so that's definitely personal, what you want to do. I mean, I spend time, if I'm in front of the screen anyway. I rarely don't watch the market. Even if I'm in cash, I'm watching the market. I might take, I'll watch the open. I might take the middle of the afternoon off and then come back and watch the close if I'm completely out in cash and there's nothing setting up. I kind of know, what my day is going to be like just based on how many stocks are setting up, whether I have anything that I'm willing to buy, because I'm not calling audibles all day. I already know going in if there's setups that I'm interested in, and things that are even close. I have an on deck list, and those could be close, and those might set up. But if there's nothing, and I don't have any positions, or maybe I have small positions and I just have stops on them that are, I set mechanically. I spend time at I have my own shooting range, and I spend a lot of time there. Those of you who know me know I do a lot of competitive shooting. So I just take that time to do leisurely things and do things that I can't do, when I'm in the market all the time.
He's saying to actually improve his trading is what he to further read the question.
Well,
But
then
what-
read. That's where you should read, do post analysis, take a look at, do all those house cleaning things where you put in and you input your numbers. You've got the analytics on the platform here, put your trades in there and get everything where you start analyzing your numbers and do all the house cleaning stuff.
David's asking on AMAT, which we got knocked out of earlier. Given the number of reversals in the $142 to $145 price range, should you use a smaller position size on the initial breakout and then perhaps bump it if it does reach new highs?
I would never go into a stock like that. I don't think that way. So I mean, you could certainly, if you want to try to guess as to which ones will be the rip roaring ones and which ones will stall. If you'd have to grade the base, and say, okay, well, this is not one that I think is, strong enough for me to put a full position on. That's, you can do that, but there's going to be so many times where you're wrong. That it's all going to come out in the wash. That's what I find. I have never met anyone that has that kind of clairvoyance. I don't, so, but now don't get me wrong. There's times where, yes, I'm taking a smaller position than I would in another setup, but usually that's because of my traction and where I am as far as how well I've been doing. But I try not to question too much the pivot points and try to have favorites. I mean, yes, this is coming into some supply, but if you waited for it to go through, now that would be chasing the stock up a bit extended. And I'd rather buy it near the pivot into that supply than chase it extended. But I don't know. What about you, Mark?
Yeah, exactly. I'd much rather buy it through the low risk entry. Once you're buying anything extended, I just don't let you're stretching your risk reward relationship.
Yeah. I mean, not that it can't be a better buy higher, but we don't know that. And we know once it's extended from the pivot point, it can pull back naturally, have a natural pullback and be enough to knock you out, just simply because the percentage is too much for, it's too much heat for you to handle from your purchase point. So that, again, that's the thing where, can you stay in the trade? So I'm always, and also how far does it have to come back down to tell you that something's wrong? If it's just going through a natural pullback, but you got to go through a 15% pullback and there's nothing wrong. Well, now you've got to go through a pullback that's too big to withstand, and the stock hasn't even done anything wrong. That's why you back into risk. You back into the trades. You try to back into them at points at which the stock doesn't have to go down very much to show you that it's not acting right. If you can't do that, then you just got to use a percentage stop.
Eric is asking, particularly looking at Tesla. He's asking, what is the benefit of the 150-day moving average? He would prefer to simplify his chart with just the 20, 50, and 200-day. And then he mentioned how Tesla, which was on buy alert last week, has the 150 below the 200, even though all the other ones are trending up.
Right. So I'll tell you, there's a few times where the only way I use the 150 is to have the 150 above the 200. And that's the trend template criteria. Here's the caveat. The caveat is that if you have an early turn where that means that the 200-day has only been up for about a month or so, or less than 4 months. Let's put it that way, but usually a month or so, month or two. You can have, sometimes you can have an early turn, you can have the 150 below. And the other situation, and you see this quite a bit, is when you have a very large base. I'll show you where the moving averages catch up. You see, this is a really big base here, right? So let me show you on a weekly. So here's a weekly, right? So now you see how you've got, this is the 30 week, this is the 40 week, which would be a 150 and a 200. You see how now you've got this large base and you flattened out and the 150 came below. That, is a judgment call. I would still consider this in an uptrend. I would not consider this little crossover here. Now this is starting to look a little stage 3-ish. So this is where you've got to really, if this breaks out, you got to watch it carefully here. If it starts faltering here, now you're getting into where, this could be a stage 3 topping situation. Once you've made a big move and you start getting to those later stage bases. But that's what you can see. That happened with Netflix. Let me see if I can pull it up. Let's see if how good my memory is, right? So I bought Netflix 2010 when I bought Netflix. If memory serves me, let's see. So back right here, maybe it was a different time because that doesn't. Oh yeah. So you got this. It was actually above it. Maybe that's not it. Let me see. Hold on. Yeah, you get this big base. You see this big giant base right here. See how you're forming. Once you go through this big basing period, you can start getting flat, even though you're coming out right here. See, it starts to flatten out and the 150 turns down. I think there was another one too. What was the other one? Maybe it was Lulu. I can't remember. I'm not good at the precedents anymore, am I? You get older, my memory's not as good. Yeah, big base here. See, big giant base. So you're in an early turn right here. You see, and the 150 is just starting to turn above. So that's how you can get. Sometimes this will happen, but again, that's the only way I use the 150.
So I noticed it's not on your daily chart though, Mark, just your weekly.
Yeah, I'm on the weekly right now.
Right.
Yeah, I don't
But
know.
the daily, you're not showing the 150.
I'm not. I don't even look at it because I've already determined that these stocks are in a stage 2 uptrend. If they're not, if they're early turns and power plays, I've already determined that. So I'm not too concerned about watching that. That's not something like it's going to be a key moving average and I'm worried about it crossing or anything.
Philo is asking, what is your profit-taking criteria for shorts, which we have on the SPY? Are they similar to what you have longs, just vice versa?
Yeah, I mean, with shorts, again, I don't do a whole lot of shorting. Okay. And when I do, I take what I can get. I try to, cover them into weakness. And if you get a, like a swing trade move that would be in a stock, a 20-25% move, which wouldn't be a giant move on a swing trade on the upside. On a short, that's a pretty big move. I mean, 40 or 50% on a short is gigantic. You think of that like a double, or a double or a triple on a long. So stock can only go down 100%. So usually 10, 12, 15%, I'm out. If I get 20-25%, that's a big short. But look, again, my shorts, account for 0.1% at best of my trading over the last 30 years, and probably 0.1% of any profits that I've made. So it really, it's almost non-existent. I just think shorting is unnecessary. I mean, maybe in a multi-year secular bear market, you can do well with shorting for a long period of a good period of time, but the market has an upside bias. There's much more money on the upside. There's only there's limited downside, and with what's happening nowadays with meme stocks and Reddit and all this stuff, I'd be really careful shorting stocks at this point. You just never know when they're going to light one up. And next thing you know, you wake up one morning and the stock's up 300% because it was a topic of some social media page. So be really careful. The downside is unlimited with a short, meaning the upside, which is your downside.
Correct. Sari is asking, with PLTR, Palantir, what is the correct base? Is it starting the one from June 29th, or is it the one that would be at the all-time high, which would make that base a 60% correction?
The correct base. So it's starting when? I mean, you have an IPO base right here, which was very nice. This is a really nice IPO base. I didn't measure it, so I'm not sure. You know,
You're saying from the all-time high there
yeah,
in February or January, February, or using the June 29th high for the base?
June 29th.
Right.
Right here.
No, that's July.
I'm sorry, that's July, June 29th. Right here. So you're saying, am I using this as the base? This whole thing is the base. This is one big giant base, and it's very deep.
Yep.
We're talking about this came off, yeah, 60%. So with that type of decline, you know, I would want it to be a big giant base, and I would want it to go through a lot of tightenings and really tighten up on that right side. Now, you know, this is just a big bottoming. You know, we're getting into semantics here. I understand what you're saying. I mean, if this went into an uptrend from here, we could certainly say this is a base. All right. But, you know, I look at it as this is where it started correcting right here. And it's been correcting and going through this spacing ever since. So I look at this whole thing as a big giant base, but you can call it whatever you want. The main thing is you have VCP characteristics right here. You've tightened up right here. You got a good entry point. And, you know, again, this is one that made such a big decline that you're not really in a stage 2 uptrend here, though. So this is, you know, definitely stretching the rules.
And Rodney's asking if you could please discuss what subtle differences you're looking for in the charts or the patterns when screening for stocks that are holding up during market corrections versus just general daily screening with stocks in uptrends.
I'm not looking for anything different. Are you looking for anything different, Mark?
No, not really. You know, there was that question earlier. Do you do anything in a down day like this? Well, I don't run any screens, but one thing I will do is I'll look across my lists. And then usually I'm just looking for, is anything green? Or if we're, you know, let's say like this morning, when we opened down over more than 500 in the Dow, what's the first couple stocks to go green? Is there a group? Is there, this morning, there's really kind of almost nothing. I actually texted you, Mark. I was like, it's just a sea of red out there.
Yeah.
So that's kind of something I'll do. It's not a screen. It's just more of, you know, kind of seeing where, is there any pocket of strength? But I wouldn't be buying those. I'd be looking at that then, you know, for when either the market makes a low, or are those is that the area where the strength kind of rotates, or do we get some pivots there?
Yeah, I'm looking at stock. Yeah, I'm looking at stocks that broke out the previous day, and maybe if they pull back to the breakout, I'm looking at the stocks that are holding up the best, and if there's anything green on the day. But as far as, you know, running screens, if we were down for, you know, let's just say we've been correcting, we're down 6-8 weeks, I might run a 6 or 8 week relative strength to see what held up during that period. But it doesn't really matter. See, if you just run your normal screens every day or once a week, whenever you're running them, you're going to see all the stocks and you're going to see the setups. I mean, I'm just looking for the setups, you know, and you know, and see if did this day break them apart? You know, like you got something like an MNDY, right? Let's take a look at that. So this is one I was whoops, sorry about that. What did I do? Okay, let's try again. Hold on, sorry about that. Pain in the butt here. So, you know, this was setting up, you know, that potential low cheat, but today blew that apart. So now this needs more work. You know, now that sort of came off my list temporarily. I mean, it's still on. I'm still watching it, but now I've got to let this is going to have to go for at least another, you know, day or a couple of days and see what happens here, because it was tightening up and now it took out those lows. So that blew that apart, you know. But there's a stock like an LQDT, which I was going to add this to buy alert. This is one that I might add to buy alert. This is just in that little handle phase and setting up this pivot right here. I mean, if this turns up above this 24.47, I mean, you could even start buying it there and maybe take a little bit of your position right there. You know, this is the way it's drifting down quite nicely here. Big base forming. Another one I'm looking at is OGD. I'm sorry, OGN. This is another one, recent IPO, forming this right side. See, it's not really affecting it very much here. So it's holding up. So I'm just looking at the exact same thing as I would normally look at. Look, you guys, you got to stop complicating things. It's so much more straightforward. And what I'm doing is so much, I don't want to say easier, but so much simpler than what 99% of you make it. And, and the thing is that you're just not good enough maybe to use a very straightforward method. So you're trying to find the magic screen, the magic indicator, the magic discussion that's going to lead you to. The magic is getting good at reading price and volume. That's the key. And then you add the fundamentals in there and you understand the category that the company is in. And then you understand how to apply the fundamentals to the technicals. So for instance, a biotech, we're not going to worry so much about earnings because they don't usually have earnings. They're not trading on that. If I know a biotech company is in, first stage trials of a new drug, but it's a power play and just tripled in a couple of weeks and it's got a perfect high tight flag. Well, I know right there something really great is going on. It's just a matter of if it's going to continue. I don't have to worry about the earnings. Now, if I'm in a turnaround situation, we've been in a recession or a certain group has been underwater, the retail group, let's say, because of COVID, and there's been lots of losses. I know that now those are easy comps. So I have to now demand that the current quarters are up really big. I want to see triple digit earnings in those current quarters. See, that's all comes from just categorizing it. So the only moving parts you have here are margins. We talk about this at the Master Trader program at nauseum. I mean, we go over all this in absolute detail in a chronological order. So those of you who have been know this, but and it's all in my books. All this is in my books. All right. You're only focusing on when you're trading growth stocks. If you really get good at this, you only need to look at margins, earnings, and sales. Those are the fundamentals you're going to look at. You're going to look at them in a bunch of different ways. You're going to slice and dice them, but that's all you need to look at. Margins, earnings, and sales, price and volume, a few moving averages for smoothing, and relative strength. That's it. That's all you need. That's all you need. Nothing more. Anything more than that is going to detract from you perfecting, the wielding the sword in a very efficient and a very pure way. Let's just put it that way, for lack of a better term.
All right. Abhishek is asking, your buy stop post on Friday for Tesla was a buy at 761.10, which was the high, just about the high of the day on Friday. He's wondering why you didn't wait for where you are there above the 762, 764 area, which was from those week earlier highs.
Well, probably I'm going to try to remember. I'm pretty sure the reason why was because the stock had rallied and moved above the high, and then it pulled back. So it tried to come out, and then it pulled back, and it didn't break out. So now, for it to reclaim that daily high, that very often I will put the stop there because now it's showing that it could come back again and reassert itself. Now that doesn't always work. Sometimes it comes back, it takes out that high, and then it comes off again. But your odds improve. All right. If it just pops its head out, sucks you in. When it pops out here, it sucks some buyers in, right? Some retail buyers come in. Now it comes back in. Now, can it hold? Can it hold? That's the question. And can it reassert itself and come back? This is sort of with the for those of you who remember the pullback buys, I have a 2-step and a 3-step. I can't get into that right now. That's a whole webinar in itself. But this is sort of a 3-step type entry. A 2-step would be where you open up quietly and then you take out the previous day's high. That's a 2-step. A 3-step is where you move up. You didn't buy it. It pulls back 2, and then 3 as it comes back and takes out that high again. That's what I call a 3-step entry. I use a 2-step and a 3-step entry on pretty much every trade that I make. It's either a 2-step or a 3-step entry, and the majority of time it's a 2-step. So now another way you could do this is maybe you buy some of it there. Mark, you would probably, if you were to use a technique like this, you would probably start your position there maybe, and then start filling it out if it got above there, and then increase the position.
Absolutely. That's what I was kind of saying. This guy's, he posted 3 pivots in this question, just reading it. And I think all 3 are less than 0.5% apart.
Right.
Well, then you've got your own, you answered your own question. Just use all 3 then. Just take
Yep.
tiny little bits on each one. If they're
And you're
that
going to get
tight,
the average, and you're going to get right in the middle of that.
Exactly. That's sort of to your point about neither one of those is a magical spot.
No,
There's never a magical spot in any of these guys in terms of, if you do the analysis right, the line of least resistance turns, you buy through the pivot. If you get 2 or 3 pivots that are, within 0.5% of each other, then buy through both.
right. You're going to get an average of that. So if you're buying at, 760, 765, and 770, you're going to end up with the average price of 765, right in the middle.
Michael's asking if you could explain how your model books are organized.
How the model books are organized.
I think just at the end of each year, you put together all the
My
charts
model
from-
books are organized in I have them organized in a few different ways, but I have all different model books over the years. But generally speaking, they're organized in setups. So I have like a whole model book of cheats, cup completion cheats. I have a whole model book of, I have a lot of model books right now. There's probably, I don't know, 30 or 40 volumes. But I have power plays. So I set them up like that. I have primary bases, all one model book of primary bases. So my model book is made up of volumes, of all different volumes, and I separate them by setup.
Okay. And then
Technical
within
setup.
each book, is it done in chronological order, alphabetical order, anything other than?
I do them mostly in just alphabetical order.
Michael's asking for both of you if you would consider increasing your short exposure if building upon success. Do you look for more shorts if your first shorts are working?
That's a hypothetical question that there's no possible way I can give an answer to that. Maybe I really don't know. I'd have to see. I mean, if all of a sudden a bunch of shorts set up and there's a whole bunch of short trades, yeah, I might take some short trades. It's all driven by the setups. Everything is going to be driven by the setups. If there's setups and they're working, then yes, but I'm not going to just add to shorts just because I'm profitable. See, that's where you guys got to remember, we're not just adding to a stock just arbitrarily. We're not just adding, because the stock's up. Some of you might have read some other books or something where they say, you buy it and it goes up a couple percent, you add to. That's not how I do it. That's not how Mark Ritchie does it. All right. Well, we're buying through pivot points. We're buying, and it has to go through. It's going to have to form another buy point, or it's going to have to be close enough, like Mark just talked about with this buy point, where, okay, we use this previous day as a buy point, as a pivot, and now the next buy point is only 0.5%. We're still within the range of not going beyond what we would pay up for the stock. So we're never buying the stock extended. We're avoiding that, at all costs.
Okay. Jason asking on the stock RAPT.
Which one?
RA.
Oh, right. Yeah, RAPT. I'm sorry.
If that's too square of a base.
Uh-huh.
that
No,
is a-
no, not at all. Not at all. No, that's pretty good. I mean, again, you see here again, look at this. 1, 2, 3, 4, 3 days from the breakout. All right, we can count 4, but from the breakout, 1, 2, 3, bang. See, same thing. Like, how many times do you have to see this? And how many times do you have to ask me, what are you doing for short-term trading? Do I really have to tell you that? I mean, there's like 900 examples in the last 6 months that the stocks break out and go up 3 days and then get clobbered. I mean, it doesn't take a genius to figure out you should be selling into that 3-day rally, whether you're scaling out or backstopping it, however you do it. There's what's happening. That's the theme. I mean, Mark, have you seen a theme so prevalent for so long? I mean, I can't remember too many times where we got like an opportunity where the market said, hey, this is what I'm doing. And it just kept doing it over and over and over and over and over and gave you such an opportunity. People are wondering, how are you making such a big return in the US Investing Championship? Are you kidding me? Like this, the writing has been on the wall for 9 straight months. I mean, it's been like taking candy from a baby. The stock breaks out, it runs up. If it doesn't keep going, you punt it. You know, if it takes off, you got 2-3 days to take your profit. I mean, this just can happen over and over and over. I think it's an amazing opportunity simply because normally you don't get, I haven't seen a period where you get these breakouts and they fail, but they give you an opportunity to grab a short move for a couple days. That's where this is a little bit, I don't know, I don't want to say different, just probably the dynamics of it are so consistent for so long that where we just, I mean, we could have went back to February and I was saying the same thing, saying, look at this, 3 days up and boom, it gets hit. 2-3 days up. It's the same thing over and over and over. I don't know. What do you think, Mark?
Yeah, well, I was going to say, normally it would seem like maybe in the past you would see a wave of this, but then everything would kind of reset.
Exactly.
So they would set up and then they work for 2 or 3 days and everything would kind of get clobbered and fail. And then you'd see a whole reset. But we've just been seeing this, where it just feels like
More and more setups. Like,
yeah, and they rotate. The groups rotate and they set up and they work for 2 days or whatever. And then it rotates to another group.
and for a short-term trader, this is like a golden opportunity. Like I haven't seen an opportunity like this too many times where, like I said, the theme is just so persistent for so long. Like Mark said, here's what normally happens. When you start getting action where you break out a couple days and then you fail, that might happen for a month. And then all of a sudden everything fails and you go into a correction. What happened this time is we just won't correct. You just keep having stock after stock after stock do that. So you're just getting a constant conveyor belt of 1 to 3 day opportunities. All you have to do is just put your stop at a mathematical number that makes sense versus what you're grabbing on that short-term move. And you can roll this over like I've done, and you're not changing anything except tighter stop and selling sooner into strength. That's it. It's the exact same setups. Everything I'm doing is from the same setups. And I know some of you get this because there's people in the US Investing Championship that are doing well. And we've got a lot of members that are killing it. We get emails and they're doing phenomenal in their short-term trading. I mean, that's where the opportunity's been.
Yeah, if you have that time.
That obviously takes, it takes more time in front of the screen. You got to be quick and nimble, and it's definitely going to be more time consuming, in that respect. So some of you can't do that, and that's fine. You should be, waiting for the swing trades, and you'll make it up too. You should be able to make it up because when swing trading is good, you're going to be. Hey, just remember this: the guys that someone who's just short-term trading, they're also. Like right now, they're selling into this, and then wham, it comes in, and the swing trader is maybe breaking even or getting stopped. Well, guess what? When swing trading works and trades make bigger moves, the short-term guy is going to be selling in 3 days and then watching it go up 50% and double. You see, there's a flip side to everything. This may not be your time, and it's that person's time. Next time, it's going to be just the opposite. So you've got to, and you're probably not going to be good enough to switch gears. And do both of these. You either, I mean, some of you are, if you've been doing this for a while, you should try to switch gears. But the key is that you don't want to completely, change cars. You want to maybe switch gears, but you don't want to change cars and, change your whole strategy. That's why I try to keep everything so I have the same reference points. So I'm buying from the same setups. I know what to expect, and I know how to measure everything from those reference points.
Juan is asking, would you recommend doing post-analysis in chronological order of trades to see if we can improve as well they're implementing a progressive exposure of each trade independent of each other?
I have no idea what that means. Mark, if you do, you can answer it.
Yeah, I think he means, when you do post-analysis, you sort of go back through and try and do some type of, I don't know, hypothetical
Well, I'm taking it as he wants to see if he was progressively exposed, increasing his progressive exposure properly by going back and going in chronological order of each of his trades in the last whatever period of time,
See, the
as
problem
opposed
is
to
you're
just
not
looking
gonna
at
get,
each trade
yeah,
independently.
you're not gonna get an accurate answer that's gonna be consistent going forward because there is no way to really quantify that to a point where it can be some kind of mechanical decision, or you say, okay, 5 trades. See, again, trying to get just a little bit too crazy with this. You got it. The key is you don't have to get this dead perfect to the number where it's 5 trades and I go to 50% and 7 trades I go to 75. It doesn't work that way. All right. The key is that you're trading heavier when things are working and you're pulling back when they're not. And this is all about probabilities. This is about, exposing yourself when things are working well and protecting yourself when they're not. Is there a magic number? No. You see, it's just like I always use poker analogies. The reason why is that, with poker, you sit down at one table and they call it game texture, the texture of the game. You've got to feel the texture of the game. You've got to assess the players. Are there a lot of good players or a lot of suckers at the table? A lot of suckers at the table, you can play sloppy and you can bluff them and you can beat them. You can outplay them even without good cards. There's great players at the table. It's a whole different story. So the texture of the game, it defines on how you necessarily play, even though the probabilities are the same, but you may be playing more conservative in certain instances and you need to have certain traction. Same thing with trading. It's very much like a poker game because just like a poker game, as the cards unfold, the probabilities change. As you see things unfolding, okay, this is getting better. This hand is improving. I'm going to increase my bet, but it's never exactly the same because just like every game, you're not going to have the same poker game with the same game texture. Same thing with the market. So this is the art side of it. You've got to understand that a lot of this is art and is operator based. And that's the magic of it. That's the great thing. That's what makes such a great opportunity. And that's what makes it such a wonderful profession and a wonderful challenge.
Yeah. I think is to say just do it independently, not evaluate, because each cycle will be different.
Really go back to do post analysis. You really want to go back and just see, are you making good bets? Are you go back and say, was that a good buy based on, all my criteria? Did I follow my plan? And was the criteria sound? And was the pivot, right? Was it tight? Was the volume dried up? Just assess that and make sure that if you're making quality choices, you're making good decisions, you're going to yield good results. Maybe, like I said, it doesn't work every time, but it works over time. So it's all about over a longer period of how the probabilities distribute. Now, if you're playing aces and kings in a poker game, you're going to do well versus if you're playing pairs of 2s and 3s and 4s. If you're playing Jack 8 offsuit, and against a guy that, every hand, if you played Jack 8 offsuit and another guy played aces and kings, he's going to beat you. Is he going to beat you every hand? No. But over 100 hands, 1,000 hands, the more hands that go, the more certainty it's going to be that the aces and kings are going to beat the other hand. So again, it's all about just making good decisions and doing it consistently. So you got to go back and see. And the main thing is, did you stick with your plan too? Even if you have a crappy plan, make sure you stick with your plan so you can go back, look at it, and then make the changes. We're down 670 now. So the market is not rallied back. I'm very happy with this. I want this market to correct here. I think there's a lot of people probably stepping to the plate this morning and trying to buy this. And it may be where there's a big surprise to the downside here. I could see this market being down, 800-900, no problem. But we'll see.
This is a good point. You were making the point earlier, Mark. I think when you had the SPY up, you have no idea where it's going to go. But this is the old, in an environment like this is when the bad stuff happens, and the market just lures people in because every time it's come near the 50, it's bounced. Well,
right.
That isn't. It's just setting a bigger trap, like you've said before.
Yeah, I
That's
still
what-
have not had a 5% correction in over or getting close to a year.
Yeah.
Um, John is asking on a stock like FVRR, when it gets a gap down in a base and then it rebounds quickly, is that a sign of strength? I'm not sure if I would call that rebounding.
What are we talking about? I have no idea what are the dates? What are we talking about here?
In that gap down,
Yeah.
he's asking this rebound, a quick rebound, is that a sign of strength?
I don't know what happened. I lost my, so is this a sign of, there's nothing strength about this stock. This stock just broke down and broke down below the 200-day. I mean, I'm not sure why I'm even answering this question while we're, asking this question. Now, this stock just broke down. This is not a base. We're below the 200-day, below the 50-day. So this doesn't meet any of the criteria. So what are we talking about here?
Yeah, if anything, this would be more looking like a short
This
setup.
looking like a short setup. Yeah.
Yeah.
You just broke down on gigantic volume. If you're asking this question, what you need to do is go back and read my books, both books, and maybe even attend the Master Trader program. If this is the kind of question that you're asking after you read my books, you're gonna need more schooling. That's the bottom line. Because you're obviously you're not you didn't understand what we were saying, or you didn't read what I've been saying.
Couple of duplicate questions here, so let me scroll down. Any pointers? Chuck is asking where he has no problem taking small losses on individual trades, but he's experiencing death by 1,000 cuts, too many losses in total, affecting his mental capital as much as his trading capital. Any pointers?
Okay, so no problem taking small loss on individual trades. I do, however, need to learn a better, more productive way to avoid letting an overall decline in my trading account value. Okay, well, that's very simple. Stop. I mean, if you're losing over and over and over, well, again, there can only be one of two things that's wrong. Either your criteria is flawed, you're not doing the right thing, or the market environment is not right for what you do, or it could be both. But those are the two moving parts. So you need to assess that and say, well, am I doing the right thing? Am I making good bets? If the answer is yes, well, then the market's not right. So then you should be pulling back and maybe even just watching and say, and placing, almost not, I don't want to say paper trades, but mental trades, where until you see trades working, then you come back in small and you rebuild. If not, then you're going to have to figure out what you're if the market's fine, then you got to figure out what you're doing wrong. You're not you don't have good rules, or you're not following them. So you could have good rules. Some people they know all the rules. Like I know lots of people that know the rules, traders that could be great traders, but they can't stick to them. Well, it's not that they can't, they don't. Anybody can, it's a choice. So they refuse to, for whatever reason, they refuse to stick to them. So there's having a good plan and a good skill and being able to actually execute it and the willingness to do it. So, I mean, my pointers are no different than, we give every week and every month and every year, is that, you're going to have to back off when things aren't going well and get to the bottom of this, of what's going wrong. Is it actually your trading, or is it the market? And why are you not, why are you staying in there and getting your head caved in? Why are you continuing to beat your head against the wall? I'd have to, this is something that we'd have to look at and really, make a deep dive into. First, I look at someone's trading and say, what are you doing? Let's see what you're doing. Okay, this looks sound. So what are you thinking? You know, why are you getting yourself, how are you getting yourself in trouble if you know what to do and you're placing good bets? Usually it's because you're arguing with the market. You keep going in there and doing the same thing over and over. You know, what did Einstein said, the definition of insanity is doing the same thing over and over and expecting a different result. So in the market, you can do the same thing over and over and get a different result. The problem is that the risk of ruin, it could take you 200 trades before it works. And in that amount of time, you blow yourself up because you've taken so many small losses. That's why progressive exposure is so important.
Question on BSY as an example. Definition of a churning day, September 14th,
BSY,
right?
what about it?
On September 14th, Brian's asking the definition of a churning day. Is it only after a stock is broken out and then has very little price movement on a high volume day?
A churning day is simply, high volume without price progress.
And does that have to happen after a stock breaks out, or could that occur in the base?
It could occur anywhere. A churning day is high price without movement.
Okay.
So that would be now where it happens and what you ascertain from it. That's a whole different story. But a churning day is no price movement with elevated volume.
Have you ever, or is it okay? Matt is asking if it's okay to go into a trade with a short-term plan, but then change it to a swing trade if things start working out.
Well, I don't like the fact of you saying change it. And, if you went in with that and had a contingency, and then that might be fine. I would want that to be a contingency within your plan. So for instance, I go in and say, okay, I'm going to go into this. If I get a quick move out of it, I'm going to sell it. The stock looks really strong. So I say, well, I can always take part of it off, move my stop to break even and free roll it for a bigger move. If the stock really shows me that it's strong, fine. It should all be part of a plan that has contingencies. So that's part of your plan. But to just go in and randomly call an audible and start getting emotional about it, I don't know. I mean, what is your reasoning behind that? I don't know what your cause would be for that. And so I can't just answer that without knowing, what is the reason why you would change just because it's up. It's up real big. I mean, how big is big? What are the parameters that are going to have you make that decision? See, I don't have guesswork. I'm not going in there and just flying by the seat of my pants. I know what I need to see. And when I see that, what it means and what my options are, how I can respond. This is all about cultivating the ability to respond. All you can do is respond. That's all you're just trying to be a great responder. And that's why it's so difficult, because a lot of people don't have a tough time with responsibility. Taking responsibility. You have to take full responsibility for results when you're a stock trader and learn how to respond to all types of scenarios and build a playbook of responses, and be able to keep some organization as to, which ones go where, and having that. This is why it's so important that you start with something very basic and you perfect that, and then you build upon that and you add elements that are basically extensions of that starting point. So you have reference points. You got to be very logical. You can't just go into trading and try to do everything and think that you're just going to learn everything and know everything and be able to have all this. You can have all this knowledge, but you won't know where to put it. It's like I give you a whole you don't build houses, and I go, okay, here's wood and hammers and saws, and I give you everything, and I just dump it all in the front yard and say, build a house. You might not even know where to start, even though just because you have all the tools and you have all the materials doesn't mean you're going to be able to do that and build that house. You have to know where to start, how to build a foundation and build from there, and measure things and survey the area and excavation. All that has to be done in a certain order. You can't put the roof on first, right? So you've got to have those reference points. You have to know where to start, and all that has to be built upon each other. I mean, I don't know, you certainly don't go to school and learn to be a brain surgeon and just come right out cutting people's heads open and going in there and doing brain surgery. I mean, you start with very, very basic things, and then you build upon it. It's the same thing. There's no difference. Trading is no different than any other business. You've got to do this in a very chronological order, start very small and build. I know I'm going off the question probably, but this is very important stuff that I'm telling you. I'm giving you, you want the secrets? I'm giving you the real secrets. I'm giving you the real secrets, not the stock picks and the screens. That's all bull. All right. That it doesn't matter. You give me I don't need screens. I don't need Market Smith. I just watch the market. Give me a list of stocks. I'll watch them all day. I'll watch them every day. I'll trade them because I understand supply and demand. I understand what makes stocks go up, what makes them go down. I understand what earnings mean and margins. Once you get that, you'll be independent. But it has to be built chronologically, and you got to start with some basics and build upon that. You're not going to go 0 to 100 here overnight.
Leos is asking, when coming back into the market from a cash position, would you be more willing to pass on lower volume, more speculative names, since you're probably going in with your position size already adjusted to
Nope.
the minimum by default?
Absolutely not. Would I be willing to, would I pass on them? I absolutely wouldn't pass. As a matter of fact, I'd probably favor them. I mean,
opportunity.
Again, you see how your forecast, you're trying to come up with rules. You're coming up with opinion. You're trying to predetermine your path. That's the worst thing you could possibly do. I'm going to trade whatever sets up. I know, it just seems like it's so hard for people to understand this. I'm going to trade whatever sets up. If a bunch of small cap stocks set up, well, I'm going to trade small caps. That's how I get myself in the right place. Eventually, I end up in the right place. Why? Because I don't sit there and say, I know cyclicals are going to work because the economy and inflation and this and that. Meanwhile, a whole bunch of growth stocks blast off, double and triple, and I'm sitting there with my opinion, waiting for my cyclical stocks to set up, and they never do. Okay. Or I know this market's going to keep going down, and I don't care if there's a follow through day and there's stocks setting up. Everything's terrible. The economy's terrible. The end of the world's coming. Kramer said it, and I'm not buying stocks. And meanwhile, you miss a bull market. Or just the opposite, you're not selling because you think it's going higher. And Tesla, Tesla's great. Coca-Cola can't go out of business, and Amazon and Google are going to be here forever, and you hold. And then you sit there and you're down 50% and wonder how you got caught in a bear market because you formed an opinion. You formed an opinion, and you're not letting the stock dictate and the setups dictate where your money goes. I've been doing this for 37 years, and I still don't trust my opinion for shit. And my opinion is right a lot. I am really good I have a great gut, and I still would never in a million years trust it, because the minute I get that kind of confidence, that's when I blow up. That's when you dig in and you say, I'm great. I know what it's going to do, and the market's wrong, and you are doomed. You are eventually doomed. I don't care how good you are, how long you've been doing this, you will blow up. When you get to that level, you start having that kind of hubris, it's all over. It's just a matter of time before you blow up. So whatever's setting up, Mark's, a total consummate pro at this too. I mean, he's just simply letting the stocks guide him.
Yeah, there's not much to add to that. I mean,
No,
I
there
think
really
a
is.
couple of the tangents you've gone on have been worth the price of today's admission, anyway.
Yeah. Like I said, this is the gold. This is the secrets. Now, these are the secrets. I think if there's any one really important thing that you have to understand is you've got, besides, risk management, cutting your losses, managing your risk reward relationship, is to let the market dictate, get off the damn indexes and follow the stocks and buy the breakouts. Buy the breakouts when they set up. When they're working, step it up. It's really that straightforward. If you follow that, you would have said in February, you would have concluded by March, you would have concluded that breakouts are working, but they're only working for a couple of days. If I sell into the strength, I can nail down these short-term profits, and I get it to peak at the next card and see if they start working for swing trades, and then I can extend my time frame. And you would be still doing that exact same formula of nailing down the short-term profits, waiting to see if they can, if you can get swing trades to work to extend your parameters, and you wouldn't have extended your parameters, but you would have made a fortune because you would have been nailing all these short-term trades into strength. Now you'll see, I'll change. You'll see a change, and I'll start talking about a whole different theme once it develops and it starts working. When all of a sudden I'm selling stocks up 1, 2, 3 days, and they're going up and up and up, and I'm going, boy, I wish I held that thing. I'm going to shift.
Scott is asking if you use, or would you use a pullback to the 20-day moving average as an entry on a power play. In particular, he's asking TASK.
TSAK. Wait,
TASK.
TASK. Yep. And what do we do?
He's asking if the pullback to the 20-day moving average there would be an entry technique.
No. Does anywhere in my book say that? In any of my books? Or have you ever even heard me say that ever? So absolutely not. Look, you're never going to hear anything from me that isn't in my books or in my workshops, or you hear here. You're never going to hear me deviate. Never. You're not going to all of a sudden hear, oh, it's this secret technique that I've been holding out on you for the last 5 years. It's not going to happen. It's all consistent. So I don't use moving averages that way. I'm looking to buy on the base breakout coming off the cheat. You don't need it. You just don't need it. There's a million. Let me ask you, what moving average is the magic number? 20, 21, 22.5, 65.8? Like why is a 20-day so magical? Because it is right now, because you see in hindsight that it bounced off of it. In hindsight, now it looks magical, right? Because it bounced right off of it so perfectly. That's in hindsight.
Morale is asking, do you look at the accumulation distribution rating on IBD when entering a trade as looking at two stocks with similar setups, one with a higher AD rating? Would that be more?
I never look at it ever. What time is it here? Okay, we're gonna wrap this up in a minute. We're just down over 700.
Yep.
I got to take to Twitter here and gloat to the hecklers now, because I did get one of the reasons why I felt more confident about this trade, and this happens all the time when people are so confident that they say that like I'm an idiot and that you got it wrong, and that I had one person on Twitter tell me that they were going long specifically because I was going short. They're fading me. That was their reasoning for their trade, to fade my trades. Which I'll say this, and I'll say this on Twitter today. Nobody has ever gotten rich fading my trades. But I was heckled. I was heckled last week for going short, which I love.
I'm sure there's a few people gotten poor doing that, Mark. But
yeah, exactly. I love when everybody says I'm wrong. That's how I know I'm going to be right, is when I'm a lone wolf. When everybody agrees with you, that's when you should start thinking you might have problems.
That's a great point.
The last thing I'm looking for is everybody on Twitter to agree with me. What are we doing, Rob?
Yeah, it's still
you went radio silent.
There's a lot of
Sorry, we can't get to everybody's questions, but try to do the best we can with the time limit. We got just a couple more minutes.
Yeah. Would you, Francesco is asking if you would buy breakouts even on a negative day like today, or do you wait to see more stability?
So it's probably a good question for you too, Mark. I probably would no, I would not. With a day like this right now and the market not coming rallying, and so many stocks breaking down, I would very rarely ever buy on this day. Whenever the market breaks, I usually like to give it, a couple days and see what happens, if it can bounce back, if it's, what type of resilience, and yeah, I just sort of stay away. Now, if let's just say there was a whole bunch of stocks setting up and we had a giant buy list and everything held up, the majority of them held up really well. And some names started, emerging. That's a different story now. And things have been working, or maybe we're in a bear market and there's a big down day, but it's looks like a capitulation day after you've had a big move down, but a bunch of stocks have set up. It's again, I'm going to come back to the stocks. Right now, we have almost no stock setting up. I can find maybe 2 or 3 that I would even consider buying right now. That would be have viable pivots. So that is definitely not, that's not going to get me to get aggressive in the market by any means. So now, if my buy list had a whole bunch of names and there was a bunch of pivots and they were tight, yeah, I might buy a few names. But even then, I probably wait and see how we close today and just take a little bit of wait and see.
Here's the last good question, I think, on OG. Even though it's low priced, the fact that it doubled in the last week, but it's just come back up to where it was before 3 months ago, decline. Would you consider this a power play?
So let me take a look at this. Okay, so that's an 88 relative strength. So that right there, I've never seen a power play with an 88 relative strength. It has gone up quite a bit. Just trying to take a look here. I mean, it definitely is meeting the criteria of a power play as far as the move that it made, is about 160%, 168% in just a couple days. So again, something is going on here. I mean, look at this volume, that launched here. So something's going on. So if this were to get tight here and put in a couple more days, or I'd like to see, I generally like to see 10, 12 days minimum. Some of these have been going sooner. You can certainly buy this and try to, play some follow through if it starts turning up. The key is to do it from from a very tight stop. But again, I would, with an 88 relative strength, this would not come up on my screen. And the fact that it's a $7 stock, this would not come up for me. I wouldn't see this. So the fact that I'm seeing this now is just simply because you brought it to my attention. I would not see this. I wouldn't be screening for $7 stocks and 88 relative strengths looking for power plays.
Okay, and actually,
Go ahead.
go ahead.
No, but this may work. I mean, this may work. I mean, it's absolutely incredibly powerful here for this last 6 or 7 days, and this could work.
And last question from David, with your SPY short, if you could share, what would be the criteria for when you would tighten your stop on a short?
Well, I mean, with this, look, what happens with these shorts, this is not a profit center for me. That's the way I look at it. I mean, every now and then I get it right and I get a good move. It depends. If I put my whole account into this, which I very often will do, when I'm negative on the market and I short, sometimes I'll go full bore because this is extremely liquid. The chances of a big gap against you is, zero. I mean, you could have a gap, but it's not going to be one where it's going to be up 20%, wipe you out, or more. So again, the way I would look at this type of trade here, and I usually do, is I'm trying to, just do it in case we get a meltdown. So I go in there and, if I can get myself a decent little move on it, if I have a big position, I might take some off and finance my stop. So for instance, if it's, down X percentage, if I sell half of it or whatever percentage, maybe I only have to sell 25% of it and it finances my stop, and I still have 75% of the position. So now I'm free rolling and I can still let it stop me out. Or if I want to, maybe I'll just move it to break even if I want to, keep the whole position. And I'm just playing it in case we get a, real quick, maybe you get a flash crash or something. That's usually when I benefit the most from these type of trades. Now, if you're scalping it and you're trading a huge position, you probably want to, start looking to take some profits. It's only down, we're only up 3.5% on it. So these aren't going to move that much, these indexes. That's why you either have to take a big position or play it for a really big move, or use it just as, a hedge against your longs. I'm not even sure. What was the question? Where am I going to stop it?
Tighten your stop.
Tighten my stop. Yeah. Again, it really depends on your plan. I mean, what your plan is, what your position sizing is, and what you're trying to accomplish. Again, you should already know that going in. For me here, again, I'm gonna, I'm gonna probably just move this to, break even at some point and then just free roll it.
Yeah. Um,
Mark, just real quick before we close up, what's going on with you? I mean, you probably have been getting knocked out of some stocks. You're probably in heavy cash now.
Yeah, pretty much. I've got a tiny little position left in that HZNP, which I've had for a while, but I've been trading really small. It's almost just keeping a pulse on stuff. I took that MNDY really small position, got stopped out this morning. It's I mean, I'm probably over 90% cash at this point. So
Yeah,
it's not we've been talking about this for a long time. There's
long
not
time.
but no reason to press anything. I don't think I've traded, an over, sort of a full position, even overweight in months, just because you just haven't had the traction.
Yeah, if you see, Mark's been sitting patiently the entire year. For a brief moment, he got aggressive and he ramped it up when things started working a little bit. We got a little bit of traction. It looked like swing was going to start working. He ramped it up and then boom, it turned around and he went right back into, the turtle position, I call it. He covered up and since then, I mean, really just been, taking token finger on the pulse trades, and just keeping his powder dry. But I could be willing to bet that, I'm sure your drawdowns are not very big. You're protecting your gain on the year, and the volatility is very low, and you're just waiting for that moment to strike and things start working to make a bunch of money. That's but this is, Mark was up over 300% in 1 year, just the year before last year. And so, when you make that kind of move, you can sit back and you can wait. See, that's the thing. Wait and then strike hard. Don't think you got to be in there and listen to everybody that says, diversification, and if you're not in the market, you're at risk. No, you're not. That's ridiculous. Only dumbasses say things like that. All right. You're not. When you're in the market, you're at risk. Being out of the market, you're not in risk. Okay, so you miss a move. Big deal. The market's going to be here. The key is to protect yourself and only get aggressive when you're just like in a poker game, you shove your chips in when you got aces and kings. Right? You don't shove them in on a pair of twos. You shove your chips in when things are going well. You shove them in when you're winning and you got stacks of chips. You lean on the other opponents when you've got a big stack and they got a small stack. Right? When the market's got a small stack and you got a big stack, that's when you get aggressive, when things are working. You built your stack up. No different. Exactly the same. You want to learn how to trade? Go learn how to play poker.
Yeah. Final comment. I was just going to say Apple, Facebook, Amazon, all below their 50-day. First time in a long time. They've all been below it. Google and Microsoft right on their 50-day. So seeing some of the leadership finally letting out some of the air.
I mean, Amazon's another example. This is, you have the dates, but I have them marked here. I guess this is where we bought and sold, Bob.
Let's see.
7-2.
Yep. Those are the dates.
And then we sold on 7-7. Can't remember if we sold the whole position there. But look, at Amazon isn't even immune. Look, 1, 2, 3, 4 days up. A couple days flat, outside day, bang. That's it. It's same exact thing. You got yourself, but look at this opportunity. Look at this nice, big, quick move up.
Yeah, you sold half on that first rally, then we held the other half to the 30th.
To the 30th, which
where we got knocked out on the gap.
Which, right. Okay, so here, yep. Let me put that little red hash in. And we got the other half was right here. But see, you de-risk the trade. Now you de-risk the trade and you can withstand this big gap down, and we didn't lose any money on the trade, right?
No, we made money.
We made money. There you go. That's how you do it. And you could have easily just sold the whole thing in here and made that that quick little 3 day. And now look, do the math. Do the math. If you think that this trade is no big deal, this happened in 3 days. Okay, do the math that you make your 5% or whatever your average gain is every 3 days, or even once a week, even once a month. and watch what the math comes out to. If you think these small moves are no big deal and they're not worth it, I've built a fortune on trading relatively small moves, not these scalps. That's not my general MO, but still, not waiting, having to get big giant, winners. I'm in the winners, sometimes through the entire move, a whole bunch of times, sometimes a big part of the meat of the move, or a bunch of times I trade it. So I'm in those winners, but it doesn't necessarily mean that I have to, find the next Amazon to make a big return. I've made hundreds of thousands of percent, and I've been in some of the stocks that have gone up 80,000%, but I've never held a single stock that's gone up 100,000%, but I've made hundreds of thousands of percent.
A lot
So
of comments on your hubris post here, as well as Rob sending me an email. Mark's hubris tangent, he's gonna says is worth putting as a video clip, standalone video clip in his library.
I don't even remember what I said, but all I know is that I've been doing this for 37 years, and I'm still as respectful of the market as I was day one. Well, probably more. Now, I'm actually way more respectful now, but I'm even more respectful. But I still wake up every day and say to myself, you could blow yourself up. You could blow yourself up. You could blow yourself up. If you don't stick to the rules, you don't stay humble, you get cocky, you start thinking you know something, you can blow yourself up. That's how I start my day, every single trading day.
Yep. All right. With that said, guys, we appreciate Mark's time, and we will have the replay up and you can listen to the hubris on the replay here in a few moments. And otherwise, stay tuned to the live stream for real-time alerts from Mark for the rest of the week.
Sorry, I didn't get to hear Mark Ritchie much today. I hogged everything today.
Yeah, this is the best kind of session.
Yeah, but I like to hear you too.
And,
we learn from each other. We can learn. I learn from people who do this absolutely incorrectly, and I learn a lot of lessons. We're all, everything has a lesson in it. Everything has a lesson in it. So, all right, I'm going to run, guys. Let's see what happens here. We're down again, knocking on that 700 door, down 710. So, this market's looking pretty crappy. That FULC is trying to come on again here. You see that strength? Now it pulled back, and this is showing. Remember, I talked about how, real quick, just want to finish up. Mark and I said that these high alpha power plays, they're in their own world. They're not affected by the market. You see, look at FULC. If that doesn't tell you, look how this stock broke out yesterday and now is following through. It's following through because it's in its own world. It's something's going on there. When a stock goes up 300% in a couple weeks or a month, something's going on there that is huge. It's just a matter of whether it's going to continue or not. That's the big question. But that's why we favor those stocks, particularly when the market's tough, because they are in their own earnings cycle or their own product cycle.
I would add real quick too, Mark, since I didn't say much, but if you do own that a name like that and you can survive a pullback, you definitely want to try and hang on to a piece for a little bit bigger move. I mean, if the market down 700 isn't going to pull this thing back, this is that that stock that might that's like the spring. The pressure is sitting on it. If the market pressure comes off, this thing could just go a lot higher.
Yeah, it could be. And, if the market implodes here and really, slides hard, it may come back and slip you out. It may knock you out. But like Mark's saying here, these are the ones, Mark, this is the type of situation that you try not to give up your position.
I bought the MNDY. We had two on the list last week, this one and MNDY. I bought the MNDY in order of breakout. It stopped me on. I didn't buy this on Friday. So go figure.
Well, there you go. There's the discipline. And sometimes, it's the right move. Sometimes it's not. But like I said, it all comes out in the wash. Next time, you'll buy an order breakout and it'll be the right one. It all comes out in the wash. You just don't know. So you just let the stocks guide you. Talk to you guys later. I'm going to run and let's see how we close today. We're down 720 now. So we're coming, I guess, new lows, right?
Just off the low, just at the low.
Just off the low, yeah. So again, this is looking, I'd love to see a real nice slide here. Really, let's get some bearishness. Let's correct this market so we can reset and we can get a sustainable move here. We start getting some swing trades working. I'll talk to you guys and keep your powder dry.
All right, take care, everyone.
Bye-bye.
Bye.